Hello, Matt.
JP, how are you?
I'm great. We're back for another episode here of our podcast recording thing.
Love it.
So I think on today's episode or show, I wanted to talk about how to make money in real estate investment. I guess specifically apartment investing.
hmm
And
hmm
I think to start, we'll try to keep the show relatively short, 20 minutes or so. But I think let's start with how you found real estate, multifamily real estate, and I'll go into my little story real quick, and then we can kind of talk about different ways that people, investors, and us, we make
Yep.
money in real estate.
Yep. So my background,
And before I forgot,
oh,
we got to introduce ourselves. So
oh,
I'm JP. I
I
realized
feel like
that our
people know
last
us by
episode.
now.
Well, if you're new, all right, I'm JP Albano. I'm a co-founder and CEO of Significant Lifestyle Communities, and I've got joined here by my business wife, Matt Shields, who
Mhm.
is our COO and co-founder of Significant Lifestyle Communities. All right, Matt, go ahead.
So for me, I had a background in construction, and I used to invest in single family properties, and this was 12, 13 years ago now, something like that. So we'd buy them, fix them up, sell them, or rent them out. So I had another company that started doing well, and I wanted to get back involved in real estate. And this was 2017, 2018. There's a lot more um, information out on the internet that I could tap into, and a lot more personalities out there, talking about things, and it just made a hell of a lot more sense going after, multiple income streams. And what I mean by that is essentially, you have a 100-unit apartment complex. That's essentially 100 income streams rather than going after one income stream at a time, meaning one single family or a duplex, triplex, two, three, four income streams at one time. So it just made a lot more sense, and that was, my desire to get involved into that business. And I'm sure you can get into how we met and all of that. So
Sure. Yeah, I think for me, similar. My background had been IT as an engineer, and then also as a salesperson selling technology to companies. And as much as I loved the job, I just wanted to find a way to create passive income. And I learned a number of things along the way. I learned, more importantly, that my personality is not such to enjoy passive income. I need to be actively engaged in things. But found multifamily as a phenomenal vehicle for building wealth, just a phenomenal industry to be in. Like, I love the fact that everyone wants to partner and work together and grow together, which is very different from the kind of cutthroat industry I felt like I was in IT sales. But yeah, multifamily, for all the reasons that you just mentioned, Matt, made a lot of sense. And I remember being inspired by the guys at Bigger Pockets. They had their burr strategy, and you do all these burring, and you can Google that, BRRR. I'm not disparaging it. It's just you do all these things, and then you buy an apartment one day. And I just said to myself, why don't I just buy an apartment? And I think, in 2017, 2018 timeline, there was this, kind of groundswell of resources and information and just things to educate yourself and get you aligned to a method or a way of learning how to do this, or try to learn how to do this and get started. And I think that's, one of the reasons why you and I met. We both went to a multifamily real estate educational platform or group, and we just got along really, really well when we started working together. And I'm glad we found it. So with all of that said, let's talk about some different ways that investors and people can kind of get involved in real estate and making money in it, because that's part of the reason why most people do this. We just happen to find another benefit on top, make the money and also do some really good in the world for doing that. So Matt, why don't you rattle off some of the top ways that people make money, whether it's a sponsor, people like us,
mhm.
or an investor that's got 100 grand in their bank account. They wanted to put it to work because they're tired of earning. I mean, maybe they're earning like 3% now versus 2% or 1% before in the bank,
Yeah,
but it's
yeah.
still not enough, right?
Yep. Yeah, so I feel like defining the GP and the LP side of things is important as well. So typically, as JP indicated, when you have a GP share, you're typically on the sponsor side of things. And,
And GP is general partner.
yeah,
JP is John Paul. That's me.
I
GP
was
is a
thinking the
general
same
partner.
thing. Like, that's a little confusing. Yes. So when you have a GP share, essentially you're performing some type of exercise, or you're contributing to that particular project, whether that be, boots on the ground, or,
You're doing work. You're
you're
doing
doing
some
work.
work.
Yeah,
Yeah.
you might be, signing on the loan, right? You're putting your balance sheet up, your net worth up, those types of things. Typically you'll get a GP share for that. And um, LP side, limited partner side of that equation, is essentially a passive role where you're more or less investing into that opportunity, and you're along for the ride. You're getting the updates as they're coming through, whatever the GPs or the sponsorship group are relaying out, as far as this is going on, these are the updates, these are the improvements, this is where things are at, right? So you're not necessarily actively involved in the day-to-day management or the operations of the project really at all. So does that make sense? Want to add anything to that?
Yeah, and I think there's some benefits and negatives, or just detractors, I guess, for both of those situations. Most people that I run into from an investor standpoint, they've got a full-time job and they don't want more work. That's one of the reasons why I was dissuaded from becoming a single family house fix and flip. And again, I'm not disparaging it, different strokes, different folks. For me, I didn't want that sort of work, even though I just told you I like being active and I want to do work. I feel like the risk reward profile for doing a fix and flip versus, investing in finding and buying and repositioning an apartment, they're just different scales, right? And so for people that want to take, again, their 50 grand, there's money in their IRA account that they maybe is sitting from their old employer. They want to move it somewhere else. They want to put it to work. Investing in real estate offers a number of advantages, right? They put some cash into a deal as an LP, as a limited partner. They are passive investors at this point in time. Their money is typically, locked into a deal from anywhere from 2 to 5 or 7 years, depending on the business plan and what the opportunity is. It all depends on sponsor. And that money on average earns anywhere from, we'll call it 7 to 15% plus annually on average over a period of time. So, it's very rare to get 15% day one on your money.
Mhm.
But if you average out from the time you put your money in the deal to when it sells, right, and you average that over the course of time, 2 years, 3 years, 5 years or so, you're looking at that sort of 10 to 15-ish% range. And in certain deals, there might be some cash flow relatively immediate on, maybe within the first year or shortly thereafter, where they're getting a little bit of cash back from that's cash flows from the property back on their investment. And we usually count that money as return of capital for tax purposes for investors, because you're not taxed on return of capital. So you put 100 grand in, maybe in the first year, you're able to get 10 grand back or 5 grand back. And we're counting that as return of capital. And then, we're working on ways of increasing our revenues so that we can get you your money back as fast as possible. And then also, we also work to do a refinance. So what we do, Matt and I, we do value add deals. So that means we buy older apartments, and Matt's in the thick of it, so he can tell you about how old they are. But they need work. They need some kind of value added, so that increases the value. So for example, we're almost doing like fix and flips, but on apartment complexes, right, Matt? So
Yep.
we're buying we rent apartments that haven't been renovated in 10, 15, 20 years. And we know in the marketplace, if we can make this apartment look nicer, we can charge more rent, right? And that's what we do. We'll put in 5, 10, 15, $20,000 per unit. And we can get $100 or $300 more a month in rent. And that money that comes out, we're able to then obviously pay the mortgage, but whatever's left over, we try to pay our investors back, and that's sort of what we do. The other piece I'll add is about the GP part. So for some of our investors, they've got maybe some more money that they have, maybe $1 million, right? That amount of capital in a deal helps us with the bank. It helps us in a variety of ways. And maybe we do an episode sort of on behind the scenes GP structuring stuff. But in situations like that, where you're a larger investor and you want to put a larger amount of money to work, we can find ways of, on top of your investment that's making money for you, add a little bit of extra cream on top, right? Giving a little bit of extra GP equity along with the deal, so that your returns kind of go faster, farther. Perhaps participating and co-signing on the loan with us, right? Like, we have to co-sign on all of our loans. These are non-recourse loans that we do with the bank. But sometimes, Matt and I's net worth and liquidity aren't enough to satisfy for the loan. So what do? we call a rich uncle, right? And a rich uncle is a euphemism for someone else that has a bunch of money, and they'll join on the loan with us. And in exchange for doing that, they earn some percentage points in the GP as well. That's another way that people can passively earn money on the deal without doing work. I feel like we should get into maybe some of the tax advantages, right?
Well,
I know.
yeah, that there's, I'd say let's I think finish out, just the actual mechanisms too on, we kind of breeze through them, but the actual mechanisms are the things, the events that happen where, on the GP side of things, you get paid. And then on the LP side of things, you get paid with those, right? So on the GP side of things, typically, you're going to be involved in, various fee type events, right? So that might be at the very beginning. There's an acquisition fee that most sponsors will participate in,
What is an
depending on.
acquisition fee?
So essentially, that is a fee that that as the sponsors would charge back to the deal, that you would, get a percentage, and typically it's 1% or so of whatever the deal is. Again, depending on the deal.
Yep.
You would get 1% of whatever that total raise was, or the total, the
Purchase
total
price.
deal was, total
Yeah.
purchase price was.
Yep.
And that would be one of the types of fees that you would charge. So basically, the GPs can get paid for doing all of the work, which sometimes this can take 5, 6, 7 months to close one of these deals, depending on the complexity of it. It can take a significant amount of work. So all of that time, all of that effort, the cost of doing business and all of that kind of gets repaid back. And by no means is this a big money making thing, but it kind of gets paid back through that acquisition fee, for that particular project.
Yep.
And our goal is to be able to get these things done as quickly as possible, so that it doesn't take that long to be able to close these deals, so that everybody can start making money as quickly as possible. And we don't have to put as much effort into that as well. So if you're on the GP side of things, you'll see, again, depending on whatever your percentage is, you might see a little bit of payment right when the deal closes.
Yep.
Then obviously there's the various events. When you refinance, there would be a percentage that you would share in at that point. There's also disposition fees.
So why charge more fees for isn't that our job to do the refinance, and why are we charging fees for that?
Yeah. So again, there is an immense amount of work that goes into, managing and maintaining these properties, and
It's above and
even,
beyond the normal day to day. Matt, how many banks did you call when we were trying to refinance Airhaven?
oh God, that was literally probably 8 months it took to finally find a bank that was willing to do that. And this was COVID times. This was during COVID
But I
too.
think it was
So
like 20 different banks that you had talked to and
yeah,
gone through a process.
and the problem is that every single person, or every single entity in real estate, essentially, oh yeah, we can do that. We
Yeah, we
can
do
help
anything.
you with
No
that,
problem.
right? So you think,
Yes.
okay, great. I've solved our problem, and you walk down the path with that particular lender. And it's not just, I got to talk to him once or twice a day. It's, oh, we need this information, that information, now this information. And every bank is a little bit different. Everybody looks at things a little bit different. And how are you doing this? And answering, you literally have to spend hours and hours and hours just to get to the point where they say, oh, no, so we can't do anything with you.
No.
And then the whole process starts over
It's all
again. So,
yeah.
so
I had
all
to
of,
add that in there because I've gotten pushback from people that, in all fairness, they've never been in our shoes to understand, what goes on behind the scenes. So basically the point I'm trying to make here is it's work that is above and beyond the normal day-to-day operations of managing the project, right, and ensuring the business plan is executed. So go ahead. So you were saying refinance for exit fee, right? Because selling is also a process too.
Yeah, which that's normally called disposition fee, right? So that's when you actually sell the property. There'd be a specific percentage that the GP pool would get at that point.
Yep.
And these are all outlined, in the business plan, so you can see, and you should be able to see all of this, on any type of pro forma that you see from whoever the sponsor is. If they're charging these different things, you should be able to see what those different fees are, right up front. So, there shouldn't be any surprises or anything like that. If you don't see that, that might be, a good thing to bring up. Like, are you charging any fees? Yeah.
Yeah.
Is there anything, here that I should know that you guys are planning on, charging at these different
A-
events.
And
So
these, they need to be disclosed in the various paperwork that investors sign, whether it's the private placement memorandum, the PPM, or the subscription agreements, or the operating agreement that investors get access to. It's outlined in there, and good sponsors, they kind of put that front forward in their deal package as well.
yep,
Keep
yep.
going.
Yep. Yeah. And then on the LP side of things, that's probably all of it on the GP side.
That's
pretty
pretty much
Yeah.
that's pretty
Yeah.
much it. Yeah, I mean,
Yep.
other piece that they're doing is they're sharing in the profits. So after a
Yeah.
certain point in time, investors get paid first generally, and then there's a sharing. It diverges. And that divergence and the size of that divergence changes as the investors are making more and more money.
Yep. Yep. And then on the LP side of things, again, just to be very specific, typically you're not participating in any type of other activities. Again, you're not signing on the loan. You're not participating in any of the, the operations or the decisions that need to be made. So you're not going to see quite as many capital
You mean
events or
when the property manager quits, you're not calling Mr. or Mrs. Investor to have them come on
right.
site and do
Yeah,
the
exactly.
rent
Exactly.
collections?
Yeah. Yeah. All of those types of stories are pretty well shielded from you. Again, you'll get monthly updates or quarterly updates on a property, and to pretty well understand where things stand and how the renovations are going. All of that type of stuff you'll see.
Yeah.
But typically, you'll once the property is cash flowing, meaning all of the expenses are paid, it's able to support itself, all of the utility bills, all of the payroll, on-site payroll, repairs, maintenance, all of that type of stuff. Once
Mortgage.
all of mortgage, yeah, once all of that is paid on a monthly basis, if there's cash left over, depending on whatever your percentage is that you own in the LP, you'll see some cash flow from that particular that particular situation. And as JP indicated, typically it's on the smaller side of things. And again, every deal is going to be a little bit different. But you can base that on a deal by deal basis. But really, the big payouts are around these different capital events, and whether that be a refinance or again disposition, which again is when the property sells.
Yep.
That's typically when you see the larger portions and potentially all of your original investment come back
We're
come
very
back to
close.
you.
We're very
Yeah.
close to that. We try to do our deals to structure them the way where we're buying the property, and we're doing our first capital, then a refinance, probably within the first 3 years or sooner. The sooner we can do it, the better, right? But sometimes there are things outside of our control. COVID, interest rate hikes that's going
Yeah.
on right now that kind of make refinancing maybe not the best time to do it, right? So there's kind of circumstance dependent, but otherwise we're trying to get to that refinance as fast as possible. And the goal there is trying to get to about anywhere from 30 to call it 60% of our investor capital returned back to them at that point in time. And that's pretty good. I mean, think about that. You're putting your money in a deal and you're getting 30 to 60% of your invested capital back within 3 years, right?
Mhm.
Or so, or more. We aim for more, but we try to, and then the rest kind of comes along the subsequent years, ultimately culminating in the exit where you've gotten all your money back plus a large chunk of profit on top
Yep.
of that.
And really the key there too is being able to find operators that have multiple projects going on at any one time. So if you're getting 40 to 60% of your money back, they might have another opportunity where you're able to reinvest that money and get it working for you again,
Yeah.
right away. And then, it just kind of keeps rolling and cycling over, that way. So, and then obviously, when the property sells, that's typically when the investment, completely pays off. At that point, normally we will close out the LLC that holds that, and essentially you won't own anything else in that particular property, and you'll get all your money back, and your capital that you've actually made on that particular asset will be returned as well.
You just reminded me, Matt. We haven't gotten the details yet, but we can kind of give some little clues here. We just finished building out our fund. We have a very unique fund, and we can do a whole show on the fund by itself. But the way our fund works is very similar to like a brokerage account, right? So you take your money, you put it in Charles Schwab or Merrill Lynch, if you have a Bank of America customer, and you can use that money to go invest in stocks and things on that. When you get cash flows from properties and you're invested in this fund, and by the way, you would invest your money in pieces of deals. So unlike a traditional fund where you put money in a fund and the fund says, I'm going to go out and buy assets that meet these requirements. You might not like that particular asset. You might like this one, whatever else. You kind of, you're a captive audience. You're a hostage, right? Our fund allows you to pick and choose which assets you want to invest in specifically. And then any cash flows or capital events or proceeds from that, go back into your fund brokerage account. And then you can invest in another fund deal at that point in time. And that's really, really unique. Plus the other benefit is you're able to get a single K1. So if you've ever invested in a deal before, you get a tax document at the end of the year, you file with your taxes called a K1 statement. And if you were invested in multiple deals, each of the sponsors are going to send you multiple K1s for multiple deals. With our fund, you'll be able to get one single K1 document. And if you're in six different properties or 20 different properties, it's one document for all of those. And that makes filing your taxes that much easier and cheaper for you in the long run with your accountant. So sorry, I didn't want to detour there, but we are sort of running out of time. I wanted to kind of keep this into a 20-minute-ish conversation for today. But what else did you want to add, Pat?
I think we were kind of at the end there. I don't know the tax side of things. I don't know if we have enough time to get into that. You want to get into that?
Yeah, I'll mention the tax benefits. So outside of making money on your money, which is great, the other way of making money on your money is not having to pay so much money on taxes. That was a really long way of saying that. So currently, at least in 2020, and it's set to become a little bit smaller in 23 and subsequent years, but the IRS allows you to write off a portion of your investment through a mechanism known as cost segregation study, cost seg. It's a lot easier to say than cost segregation. And it's good segregation, right? There's bad segregation and good. This is good segregation because what it means is the accountant or a specialized accountant is able to take the land, separate it from the building itself, the asset itself, and apply different levels of depreciation that we were allowed to write off over the course of 27.5 years into a shorter window. Maybe the first 3 years or 5 years or 2 years, whatever. And so what that means for you is you put 100 grand into a deal, you're able to get anywhere from 50% to maybe 100% or more of that amount, that 50 grand as a write-off on your investment the year that you make that investment. So for example, 50 grand into a deal for 2022, let's say you owe the IRS 45, well, bad example, let's 100 grand, right? You can write off $50,000 on your taxes in 22. And that means you owe $50,000 as a result of that. And more importantly, your money, your 50 grand that's in the investment, it's now working for you and you're making money on your money. So you're going to make your 15, 20% on top of your investment instead of doing what a lot of people do. They might lease an expensive luxury car, or they buy a boat, or, if you got enough money to spend, you buy a plane and then you sell it, a year later. At least this, you're putting your money into an asset that's going to appreciate, it's going to grow for you, make more money for you. And then you also get the tax advantages for it. So we are not tax professionals. I know we might have convinced you that we are, but you definitely want to reach out to your tax advisor and your tax professional to get clarity on that. But that's generally the other benefit that people love about multifamily and its ability to preserve wealth and generate generational wealth for themselves and their family.
Yep. And I should also mention too that one of the other unique things that a lot of people don't necessarily understand is when you refinance a property, none of that money that you are getting back at that point is taxable either, because essentially it's considered debt that you're taking on. So another nice way to be able to look at these things, because certain deals, certain sponsors, also people will hold these deals for many years. And essentially just keep refinancing them. And that's, kind of the strategy is buy these things once and hold on to them, maintain them, keep them up, and just keep refinancing them every couple of years and pulling that cash out, those proceeds out. And again, none of that is taxable at that point. So,
well, I know we have to jump in a second, but let's just, I want to dig into that a little bit more because I don't know if it gets lost on people. So, you think, how do you do that, right? How do you buy an apartment complex in 2022 and then, over the next 15 years, refinance the thing 2 or 3 more times, right? Well, if you look at what, inflation each year, this is like a hot subject right now because inflation is really high now, but the Fed is supposed to be keeping inflation at this 2 to 3% value, which if you read shadow stats, it's actually much higher than that. But so the cost of buying that apartment is going to increase over a period of time. We're able to increase rents each year to kind of keep up with our expenses, right, and inflation and those things. So $1,000 a month in 2022 could be $1,100 in 2023, and it keeps going along the way. So our revenue are increasing, our expenses are increasing too, but hopefully not at the same level that our revenues are increasing. And because real estate, the way it's valued, right, it's valued based on how much bottom line money it makes, NOI. The bank's able to see value in that cash flow. And so, we're able to go back to the bank in, X number of years time and say, look, we've created this much equity in our property. We want to be able to capitalize that and take on a mortgage for that. And so, through the process that we're able to tap into is taking on new loans, resizing those loans based on the equity that's in the property and the cash flow that the property generates. We're able to do that. And so all along the way, we were able to kind of, it sounds kind of crude, but like, smack on the keys of the cash register, spit out some money from the bank there, and distribute that back to our investors as return of capital. But that's a tax free, pull out of money when you're doing a refinance, and you can do that, not as many times as you want, but you sort of can, as long as the property fundamentals can support it, and you've got enough money to support the mortgage, and it makes sense to do that. You can do that. I know for example, our Shaker Heights deal, in theory, right? If we bought this thing for $16.7 million, if we've mapped out where this thing can go from a revenue standpoint and expense standpoint, we just got validation that it was valued at $30 million in a year and a half after acquisition, right?
Yep.
And if we keep going with our improvements and increasing those revenues, I think we were at 40 million plus.
Yeah, it was about 40 million. Yeah. Yep.
And if you keep mapping that out, like where we're going to be getting everyone's rent over the next few years, where that should be going, you're looking from 30 to 40, if not $50 million, in a point in a few years. And a few, I mean like 3. That's not a big deal. So it's really phenomenal. I get really excited about why multifamily is so awesome, I think, compared to other asset classes. So I don't want to keep talking about that because I think we've beat the horse to death there. Anything you want to add, Matt, before we let everybody go?
No, I would just say that, obviously we've talked about a lot, and we've been, studying this and deploying these methods for a number of years now. So, if there's any questions or anything at all, feel free to reach out, and, we can walk you through how you should be looking at these different things or strategies, or whatever that you might be questioning at that point. So feel free. We're here to help. So
we're here to help, and we have deals, and we're always looking for investors that want to help grow their generational wealth for themselves and their family. So Matt, with that, thanks so much. I will see you on the next episode.
Thanks, JP.
And
sounds good.
I'm going to shave for next time. I'm going to match your small cut down beard.
I had a bushy beard for November, the no shave November, and I had to get rid of it. I actually messed it up when I was shaving, so I shaved it all off. It was clean faced for the first time in a couple of years. So, but yes.
Yep. All right. See you next time, Matt.
Take care.
Bye.
Okay. Let's see.